Y'all ready for this? Let's go.
Welcome back to the Ben James Smith podcast. Up to now, we've spent a lot of time talking about how capital behaves, why structure matters, and what separates institutional investment platforms from individual deals. Today, I want to bring that together in a more practical way. Not in theory, but in terms of how a model is actually designed to work for investors. Because ultimately, that's what matters, not just what an investment is, but how it behaves. Most investment conversations begin with return, projected upside, profit margins, exit values, but the starting point here is different. It's protection. Because before capital is grown, it has to be protected. And that protection doesn't come from optimism. It comes from structure. Protection is built into the system, not added later. It comes from how capital is deployed, how progress is monitored, how decisions are governed. Every project operates within a framework where funds are released against verified progress. Independent oversight is in place. Reporting is structured and consistent, so capital is not exposed all at once. It moves in line with delivery. One of the most important elements in any investment structure is independent oversight, not internal reporting, independent verification, because that creates objectivity, quarterly valuations, structured reporting, external administration. These aren't just formalities, they create discipline. They ensure that what is happening is measured consistently and that investors are not relying on interpretation but on verified information. Another key element is infrastructure, not visible on the surface but critical underneath. The platform operates with institutional grade administration and reporting, which means investor onboarding is structured. Capital flows are controlled. Reporting follows defined standards. Compliance is built into the system. This creates something very important: confidence, not based on trust alone, but based on process. One of the biggest issues in traditional development structures is misalignment. Different parties with different objectives, different timelines, different pressures, and when those pressures appear, decision-making becomes constrained. This model removes that layer of conflict because capital sits within one structure. Debt and equity are aligned. Decisions are made based on outcome, not negotiation, and that allows projects to be delivered properly. Because of that structure, something else becomes possible: the ability to access multiple opportunities without dependency, not reliant on external lenders for each deal, not constrained by third-party timelines, not forced into decisions due to capital pressure. That allows the platform to operate consistently across different locations, across different projects, using the same framework each time. When you bring all of this together, the objective becomes clear. Consistency, not one successful project, but a system that delivers repeatedly, where capital is protected, decisions are structured, outcomes are driven by process, because over time that's what creates performance. So when evaluating any investment model, it's worth looking beyond the surface, beyond the deal, beyond the projections, and focusing on something simpler. How is capital protected? How is it governed? And how does the structure behave when conditions change? Because those are the things that determine outcomes. Thanks for listening. And remember, strong investments don't rely on good conditions. They rely on good structure. I'll see you in the next episode.